The Fed once again raised interest rates by 50 basis points on top of signaling that more interest rate hikes are likely to come.
The committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go.
And this is putting interest rates at the highest level we've seen in 15 years, since 2007. And the main reason the Fed is hiking the interest rates is to help tame inflation. As you know, inflation has been out of control, peaking at nearly 9% earlier this year. But the good news is we saw inflation ease in November, with the CPI rising less than expected at only 7.1% year over year. Now, I know a lot of people watch these videos and go,
Jeb, it's still rising 7.1%. How can that be a good thing?
Well, it's a good thing because it's less than where we were last month. It's showing that what the Fed is doing by raising the Fed funds rate is actually working in bringing down inflation. On top of that, the 7.1% increase in CPI actually came in less than what they had expected, as they had expected it to come in at 7.3%. And as we've discussed before, when the data supports what the market is expecting, that's a good thing. It's a good thing for interest rates. It's also a good thing because it produces less volatility in the market. And when there's less volatility in the market tends to act more rational. You don't have these big jumps up and down with regards to interest rates, which is one of the primary reasons that we've seen the housing market stall so much, is because interest rates have risen since January of last year. But with the inflation numbers coming down, we've actually seen the 10-year Treasury note pull back. We've actually seen the 30-year fix pull back, and we're now sitting at the lowest levels for mortgage rates in nearly 3 months. And because of this, we've seen a jump in mortgage applications, more people looking to jump into the housing market because of this pullback in interest rates. These are likely people that have been sitting on the fence for some period of time, just waiting for interest rates to pull back. Maybe they were a potential seller, and now that they've seen interest rates pull back, they've put their home on the market. Now they're willing to buy something else. It's really hard to say, but with the pullback in rates, we've actually seen the market pick up a little bit. But with that said, we're not out of the woods yet, as the Fed has signaled that they're willing to raise interest rates upwards of 5.1% based on the latest Fed survey. As you can see here, the dot plot from December of 2022 shows the median rate at the end of 2023 at 5.1% versus 4.6% at the September 22 projection. For 2024, the median Fed funds rate target is 4.1% versus 3.9%. And then for 2025, the median funds rate target rate is 3.1% versus 2.9%. So as you can see here, many of the Fed funds members have actually changed their projections on where they see the Fed funds rate. In fact, here's an updated chart showing the change in old dots versus new dots versus those that were unchanged to begin with. So with the Fed funds target rate currently sitting at 4.25%, that means many of the Fed members see us raising almost another full percent before starting to slow or even potentially pivot with regards to their hike in rates. So the question is, when will inflation peak? Well, I want to throw this chart up on the screen. This is the core CPI. That's a little bit different than the headline CPI, as the core CPI actually excludes food and energy. And the core CPI is really the one that the Fed follows the most. So as you can see from this chart here, I took the liberty of updating October's to a 0.3, November's to a 0.2, so that you have current readings going backwards to June. But going forward, we've got December, January, February coming up that read 0.6, 0.6, and 0.5. And if inflation stays where it currently is at the moment, somewhere around 0.2, that likely means that you've seen the peak in inflation, and those numbers will continue to moderate. Now let's take a look at the CPI month over month chart, as really this is the most important chart out there. Year over year is almost guaranteed to continue to come down each and every month for the next 7 months until July's 0% print. Over the course of the last 5 months, CPI month over month is averaging a 0.2% increase. If we project this over an annualized rate, then we'll be sitting near 2.4% year over year, which is really, really close to being in line with the Fed's 2% target. So basically what I'm saying is, if you see inflation continue to do what it's done over the last couple of months for say the next 6 months, then by June or July of next year, we could be sitting in the 2% range with regards to inflation, which means that interest rates are also likely likely to come down during that period of time. As we know, interest rates follow inflation, which we're actually going to talk about here in just a minute, how the future of housing is likely going to be impacted by what's actually going on with the Fed. But before we dive into that, I want to take a minute here and ask that you hit the thumbs up if you found any value in this video at all, and feel free to subscribe to the channel to stay updated on everything real estate related. Now, for many of you watching this video, I know that you're continuing to get hit by what's going on with regards to inflation. Even though it's coming down, it's having an impact on your budget, on your standard of living. In fact, the other day on my channel, I asked what you thought was actually going to happen to inflation prior to the numbers coming out. And in the comments, a few of you mentioned $4 milk, $6 egg, and $7 butter, which are clearly having an impact. As you can see from this chart here, from the biggest inflation movers in 2022, those things that you mentioned are at the top of the list, right under fuel costs. So my viewers out there clearly know exactly what's going on when it comes to how inflation is actually impacting their wallets. But the real question is, how does all of this actually impact you as a potential home buyer as you move into 2023? Does inflation coming down give you a better opportunity to buy a house? Does inflation coming down make it more difficult for you to buy a house? Well, I want to take a minute here and actually talk about that in a little bit more detail. So as I mentioned a moment ago, as inflation comes down, interest rates are likely to follow. And assuming that happens, I think it's going to provide some stability in the market. But I do believe that's going to take some time. I think interest rates need to trade in a range for a period of time to bring that stability back to the market. Now, as interest rates tend to go lower, I think that's going to bring some more activity into the market, more buyers into the market, potentially more sellers into the market as well. We're also going to be going into a time next year when the spring selling season is starting to hit, and that's typically a time when more people are listing their homes. I think that is going to happen, assuming interest rates do moderate a little bit, and I do expect to see interest rates in the 5% range during the first quarter of 2023. And I think with that, it's going to stimulate the market a little bit, but I don't expect the market to go crazy just because interest rates have pulled back, as I believe housing affordability is still a major issue for a lot of people. And because we haven't seen home prices pull back substantially, housing affordability is still a problem for a lot of people out there. Now, with that said, new construction is one of those areas of the market that could continue to get hit a little bit harder than existing home sales. Why? Because builders aren't in the business of holding on to properties. And with that said, we know that builders have about 6 months of unfinished inventory out there that's going to be hitting the market sometime in 2023. So if you're in a market that has a lot of new construction, you could see a greater impact on prices in those markets than in markets that don't have a lot of new construction. But at the same time, we're seeing companies like Lennar looking to sell thousands of homes to investors to be used as rentals, which has been one of those problems that we've seen over the last couple of years. In fact, that's one reason that we've seen house prices shoot up so quickly, is because we've seen these funds come into some of these areas, in the Southeast, where they're buying up these super affordable houses and they're turning them into rentals. And that in turn is not only driving up rental prices, but it's also driving up the entry-level prices for first-time home buyers. On the flip side of that, if you see inflation continue to rise, which I honestly don't think is going to be the case, but if it does happen, then you're likely to see interest rates also continue to follow that, which is going to put further strain on the housing market, causing housing prices to continue to slow even further than what we've already seen. With that said, I do believe that we've actually seen the peak in interest rates, whereas today we're sitting in the low 6% range. So I don't think we're going to see rates any higher than we saw a couple of months ago. I don't think we're going to see the 8, 9, 10% that a lot of people out there were predicting. But I will say, if we did see interest rates go back above that peak, it will continue to drive housing prices down. Now, with that said, many of you know that I'm super bullish on housing long term because of the generational wealth it creates long term. And because of that, I want to throw 2 different charts up here on the screen. The first one is the future of housing prices chart. Now, this is a chart from the National Association of Realtors. Actually pulled it from my coaching company, Buffini & Company. But what I wanted to point out here is in 1970, the median home price back then was $23,000. In 1980, it was $62,000. 1990, just under $100,000. In 2000, it was $150,000-ish. 2010, it was roughly $173,000. 2020, $300,000. And what I'm trying to point here is that over time, because of inflation and because of wage growth, house prices are going to continue to increase. So you can sit on the sidelines waiting for home prices to pull back, or you can get into the game and own a house. And as long as you're buying it for the right reasons and plan on owning it long term, then you're likely going to be setting yourself up for success in the long run. On top of that, here is a price of median rents in the United States, where you can see in just the last few years, rents have doubled. And because of the lack of housing out there, corporate institutions continuing to buy property, this is only going to get worse. But with all of that said, I'd love to know your thoughts. Where do you think CPI is going? How do you think that's going to affect interest rates? Where do you see home prices going in 2023? Doesn't matter if you're positive, you're negative, whether you agree with me or not. I'd love to hear your comments, so do me a favor and put them below. Now, just a couple of weeks ago, I was talking about household debt and its impact on the economy and how I think that's going to affect the 2023 housing market as well. So if you're interested in checking that out, do me a favor and go here.